Hedge funds use a range of strategies to generate returns for investors. The edge refers to the hedge fund's ability to generate returns that are not closely correlated to the returns of traditional investments such as stocks and bonds. With the use of complex financial instruments, short selling, leverage, and other techniques, can hedge funds achieve super returns? To answer this and address the audience on the hedge fund edge, I welcome Mr. Vaibhav Sanghavi. He is the co-CEO for Avendus Capital Public Markets Alternate Strategies LLP. He has made a significant contribution to the development of AIFs in India, being an advisor to and member of various industry bodies. A frequent commentator on markets and AIFs, he pioneers conversations and dialogues that shape the future of the AIF industry. Over to you, sir.
Thank you very much, Akriti, and thank you, for having us, on this presentation and giving us an opportunity to communicate and interact with, all the investors, clients, and all the market intermediaries as well. We've always known that, hedge fund is a concept, which is always intrigued many investors. What is exactly about, why, hedge fund is an important part of your portfolio? Let's kind of explore into plain, simple language and plain pointers. And I'm not going to make it extremely complex at all. And I'll try to the best of my ability to kind of see, how it can, provide you a differentiator, a great balance to your portfolios and more understanding about the hedge funds on an overall basis. When we talk about hedge funds, what makes them, something called hedge fund? It is their ability to kind of hedge portfolios. And why would that they have the ability to hedge the portfolios is purely because they can take positions which is on the short side. Now, everybody knows that the markets are never linear, meaning that they will not always keep on rising, nor always keep on going down, right? You will see volatility, you will see periods of bullishness, periods of bearishness. And in that perspective, if you combine the behavioral aspects of investors, you will find generally that because investors, get psychologically impacted by the movement of the market, they will usually they have a tendency to kind of buy the markets at the top, because at that point in time, the narrative is pretty strong. Everybody is talking about being bullish. They get eluded and enter into the market. Thereby, if the market subsequently kind of corrects, they kind of have a bad experience. At the same time, what also happens is when the markets are very bearish and are at those levels which are, I would say, on a distressed basis, then the narrative is completely negative across the board. Now, if you see and go and recollect back, in 2008, or probably at the time of the COVID in 2020, we've seen many investors kind of saying, okay, guys, this is the end of the world. And let me kind of liquidate my portfolio. Whatever I get, I'll just take it back. So in that scenario as well is when you have to go and actually go and buy, but a behavioral aspect would not probably, give you that courage to do so. So in case where you have an ability to do short, and when the markets are going down, it actually gives you a great hedge. And it is not only restricted to your equities as an asset class, but it's across the asset class where you can hedge on the other side, where the whole street is on the buy side. At the same time, I mean, from a hedge fund perspective, the other flexibility is always that you can have good amount of cash in your portfolio when you don't understand, right? And there would be various instances, many situations where one would not understand the markets. In those kind of period, it is better to go in cash, waiting out and say that once the market kind of stabilizes, you may go in again. All these flexibilities is what makes hedge fund an ability to give, how you hedge on your portfolios. Lastly, on this slide is that they would have, in a hedge fund scenario, they would have various different investment concepts and theses which you can probably use. And just to name a few, only in equities. You have relative value strategies, you have market neutral strategies, you have absolute return strategies, you have fundamental strategies, you have quant strategies, and the universe keeps on going up. So different styles trying to aim at the same concept, which is trying to hedge up, give you that return while hedging your portfolios. And the next slide, we will probably see that, we will move on the next slide. Yeah. Well, and when we talk about, the edge, what you get from a hedge fund, while I went through the ability or probably what actually constitutes a hedge fund, what is it that gives them that edge, in terms of generating those kind of risk return or risk adjusted returns? The first and foremost is basically the ability to take advantage on price, information, and fundamental dislocation. And what may happen always is, you may see a stock kind of, going up at 60 times PE valuation, 70 times PE valuation. And for some reason, if you see a problem in that industry, the best thing a long only fund manager would probably be able to do is kind of go and trim down their holdings into the portfolio. Whereas in our case, what we also have that ability, which I did mention earlier, is basically we can take a call against that stock to go and short as well, which is called the fundamental dislocation, when we think that the fundamental value is kind of pretty priced up and there is a change in the underlying business model. Similarly, on different variables like price and information is when you can take those kind of opportunities and try generating those returns. The second point I have already covered in terms of the ability to hedge, which is in turbulent markets, weak markets, this gives you a great additional advantage. This is one of the most important points in terms of saying that it has an ability to generate that risk-adjusted returns. Now, we always use this concept in a very loose kind of fashion, right? What is risk-adjusted returns? In our view, every unit of risk you take, the commensurate returns is something, is it better or worse? Now, when we talk about risk-adjusted returns, I think that equation has to be much, much positive, in the sense that when we kind of try and generate returns, if you are able to generate those returns with a volatility which is very low, with the drawdowns meaning your negative returns pretty low, then it's a great concept of having risk-adjusted returns. Meaning, if the index is kind of has generated, say, for example, in last 10 years, about 11%, at a volatility of 15%, which is your Nifty volatility average. And if we are able to generate that kind of similar return, which is about 11% on a gross basis, but with the volatility of, say, about 5%, then that's a great concept of risk-adjusted return, because you are actually taking out tremendous amount of the volatility from your kind of risk profile or from your return profile, which is where I would say it's a great edge. In terms of the portfolio diversifier, I think, and I would combine that with the last point, which is your uncorrelated returns. From a portfolio perspective, you might have some allocation to equity, some allocation to debt, some to commodities, real estate, and so on and so forth. But we have seen many a times when all the kind of asset classes move in tandem, right? In those kind of periods is when the ability of an hedge fund to kind of generate returns, uncorrelated returns, will help to balance out your portfolio. There will be, of course, some times when you will see that hedge fund may underperform, but that's perfectly fine, purely because it actually gives you that balance, overall balance from a medium to longer term, in terms of the investments. In the next slide, we'll see. I think there is a lag in terms of the change of your slides, but yeah. When we talk about, again, market being, the investments being market agnostic, and I'm expanding a little bit in terms of the uncorrelated returns, right? We talk about a bearish phase, bullish phase. We talk about markets being volatile, or any kind of markets where you may have a geopolitical event, you may have any event which can have a very binary effect on the markets, or whatever type of market we may say, right? There is an ability for a hedge fund to kind of generate that kind of returns as well. So irrespective of market conditions, if you are able to generate returns, I think that is something which goes greatly in terms of the portfolio diversification and the balance. Also, it doesn't have to be a single asset class. It can be, again, equity, debt, it can be commodities, it can be anything. However, in India at this point in time, largely prevalent is the exposure towards equities, while the other markets would, or the other asset classes would develop over a period of time. But at this point in time, we'll focus probably on equities. Lastly, it has a fabulous ability to kind of change or adjust to the changing variables. And what do I mean by that? If you remember, in October of 2021, when we saw that Federal Reserve kind of came and changed their stance from being to being kind of hawkish and started to increase the rates, we had that adaptability to kind of go and change the portfolio construct and react to those market conditions or the event pretty quickly. We can rebalance our portfolios, we can do many things to try and adjust to the changing underlying variables. Lastly, in terms of the tools for the edge, I would say most important is the talent, right? I mean, you will not find, there's a rarity in terms of the talent where people can kind of absorb the capacity or have the capacity to look, or short the markets. It needs a different mindset, but definitely talent is something which needs to be cultivated going forward. In addition to that, the data which is required to analyze is also critically important. The risk monitoring systems, a very robust risk monitoring system would also help to kind of reduce your volatility and the drawdowns. In terms of the research, ability for lateral inputs. Now, what do I mean by lateral inputs is basically, and I'll give you one example. It's basically in a market like a US, right? There are, again, I'm not saying that is something which we do, but an example where a lot of, say, for example, drones are used to actually survey the movement inside and out, the amount of people going into a retail store, right? Just trying to give primary inputs in terms of understanding how is the company going to do. So ability for lateral inputs and an open-mindedness to absorb them is definitely a tool which gives you that kind of edge. And lastly, to conclude, I would say advancement in technology, adaptability of technology in terms of artificial intelligence and machine learning is something is for the future. That is going to come about, and my sense is basically if you use that as a tool, probably you will continue with your success of uncorrelated returns. So I guess I have kind of provided you why a hedge fund is important, what a hedge fund can do, why it can do, and what is the sustainability for that hedge, from a hedge fund perspective. Thank you very much for having me. Over to you, back to the studio. Akriti.
Well, thank you so much, Mr. Sanghavi. That was very interesting and there was a lot to learn over here. Personally, I am going to absorb all the information and capitalize on it.